Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to look at IAS 10, Events After Reporting Period. And we are going to make it very brief but very understandable. Now, what do we mean by events after reporting period? Let me just give you the overview. What we are going to do basically is that we are going to deal with, when financial statements are prepared, we know that accounting period or accounting year is a 12-month period. It could be from January to December, or it could be from, when we talk about a financial year, we don't necessarily mean January to December all the time. It could be from 1st April this year to 31st March next year, depending on when the business began operations and when the financial year of the business starts. Now, what we are going to do here, I'm just going to assume the normal 12 months calendar to explain something to you. So if an accounting year begins from 1st January 2022 and ends on 31st December 2022, this is a 12-month calendar period. Now, this is what we call the reporting period. Please take note. 12 months is called the reporting period. So it means that at the end of the 12 months or at the end of the year, we prepare final accounts or end of year accounts. Now, events after reporting period, we are trying to look at after we are done with the 12 months and we have entered a new year. The events that will come to the notice of the accountant, which may have existed at the end of the financial year or happened after the financial year has ended or the reporting period has ended. We are going to consider whether to adjust or not to adjust them. Now, let me also explain something to you. In practice, usually when an accounting period ends, end of year accounts is not supposed to be prepared and completed on the last day of the year and make it ready for issue. No. Usually, the accountant is given time to prepare the accounts, usually a period of 3 months. In most cases, in Ghana, I'm aware that usually it's a period of 3 months. From January to maybe 31st March of the following year, which is 2023. So it means that in the first 3 months of the following year, it's still a period where accounts for the previous reporting period are being prepared. In other words, the year has ended, but we are still preparing and adjusting the financial statement for approval. Now, if the authorization date is 31st March, then it means that after 31st March, you cannot adjust the previous period financial statement again. Now, we are talking about events after reporting period. And I'm going to give you the definition, and please pay attention very well. Events after reporting period are conditions that could be favorable or unfavorable that occurs between the last day of the reporting period and the date at which the account is authorized for issue. So it means that if the 3-month period is allowed, then whatever happened after the reporting period or post-reporting period events, that could be favorable or unfavorable. That occurs in between the time or the last day of the reporting period to the date that the accounts will be authorized for issue. Any event that happens within this 3-month period, we call it event after reporting period. Now, most of those events that happen affect or may have changes on the financial accounts that are being prepared. And that is why we call them events after reporting period. The purpose of this standard is to determine which of those events to adjust on the financial statement and which of them not to adjust. And so we are going to basically look at adjusting events and non-adjusting events. That is the key for this standard. Adjusting events and non-adjusting events. So events that happen after the reporting period till the time of authorization of the account. So a lot of things could have happened within the period. So the accounting year has ended, but during January the following year, something may happen. Now, the accountants need a discretion to determine whether this event that is happening in January 2023 relates to the current year or should be adjusted on the previous reporting period financial accounts, which we are still preparing. Of course, at the end of the grace period, let me call it the grace period or the period of authorization. Once we enter into April, for example, whatever event that happened cannot be adjusted again on the reporting period because the date of authorization has elapsed. And so normally every accountant is given that 3-month period post reporting period, so that you can work and adjust on events that may have an effect on the previous period financial statement or may not have an effect on the previous period financial statement. All right. So like I was saying, now these events that happen after the reporting period, it's not events that will happen till or whatever, but normally there is a grace period. And the last day of the grace period is the date that the accounts are authorized for issue, okay, by audit, internal control, whatever, depending on the business approach. But what we are trying to say is that the last day of authorization, when it elapses, you cannot consider any events after the reporting period. So let's assume it's this 3 months as we are saying. Now, if it is the 3 months as I'm saying, then I have also mentioned that there are two types of events after reporting period. We have adjusting events, and then we have non-adjusting events. We have adjusting events and we have non-adjusting events. Now, what are adjusting events and what are non-adjusting events? An adjusting event is an event after reporting period that provides evidence of conditions that existed at the end of the reporting period. Okay, adjusting events are events after the reporting period that provides further evidence of conditions that existed at the last day of the reporting period and which may affect the going concern of the whole or part of the organization. So when you realize that any event happens from the last day of the reporting period to the date of authorization of the account, and you realize that that period you are still in the process of preparing the accounts or making adjustment, that event that has happened has an effect on the going concern of the entity relating to the previous period, then you need to make adjustment for that in your financial statement. If there is any event that happens that does not have such evidence, you don't make adjustment. Okay, so non-adjusting events are events after the reporting period that only provides indications of events that existed after the reporting period. In other words, it does not provide evidence of things that existed during the reporting period or at the end of the reporting period, but rather non-adjusting events are conditions that usually become relevant after the reporting period. So we are going to look at adjusting events, some examples. We'll look at non-adjusting events, some examples. But let me just make it more practical for you to understand something. Now let us look at some examples of adjusting events. So I'm going to give you examples of adjusting events so that you know when to adjust and when not to adjust. Now the first one that I'm going to give you is allowances for bad debt or irrecoverable debt. Now, so when you are preparing your financial statement and you realize that in January 2023, for example, you are preparing accounts for 2022 to the year end December 2022, but in January you discover that it's likely that some of the debtors are not going to pay their money. So you have to create an allowance for that, and it should relate to the previous year, even though the event is happening in January or February. So an allowance for recoverable debt is very important, and you have to adjust it on the financial statement of the previous year, even though it happened in January the following year. Now the next thing that you should know and adjust is allowance for inventories, or what we call inventory adjustments. It's very, very important to know that in the subsequent year, even though it has happened in January this year, you are preparing accounts for last year, you have discovered, for example, in your closing inventory statement, you have stated that you have $20,000 of closing inventory. And then you discovered in January that actually 5,000 of the goods are damaged in the warehouse. You don't continue to report 20,000. You would overstate your profit and violate the prudence concept. And so what you have to do is that you are going to do an inventory adjustment and then reduce the closing inventory down to 15,000 so that you can satisfy the prudence concept. And so even though you are discovering it in January 2023 or February 2023, you adjust it for the accounts of 2022. It's very, very important. And then also, please let me also mention this, that you see these things that I am mentioning, In the exam, when you have a question on this, it's very practical. Mostly you are asked to advise. Okay, so you'll be given for a scenario where a company is preparing accounts or financial statements and they have discovered such a thing, and then you are being asked to advise whether they should adjust it on a financial statement or not. So you need to have a lot of knowledge about adjusting and non-adjusting events. Now, the next example that I'm going to give you for adjusting events is the discovery of fraud and errors. Of course, you need to do adjustments when you discover that there is fraud or an error somewhere in your account. Let's give an example that you have reported that in your bank account or your end of year balance for the bank is $20,000 or $15,000, or let's say $100,000. And then later you realize in the next year, January, early January, as you are still preparing the accounts, that actually there was a fraud that has reduced the bank balance to 80,000 instead of 100,000. You don't continue to report 100,000. You need to make an adjustment of the 20,000 off to maintain your balance at the true figure of 80,000. It could not be fraud, it could be error, that they did a wrong recording of transactions and you need to do the adjustment. So these are some of the adjusting events and you should understand them. In fact, I'm not giving you all the examples in the world. I'm giving you some examples that will guide you to understand the concept. And then also the receipt of information regarding taxes. The receipt of information about taxes or relating to taxes. Now, for example, let's say you are aware that the corporate tax rate in your country is 25% for the company. And then in January, you are preparing accounts for the previous year and you receive an information or a note from the revenue authorities or the government that the corporate tax rate has been increased from 25 to 30%, but it is taking retrospective effect. So even though the event has happened in January 2023, because it's taking retrospective effect, you need to adjust that on the financial statement or you need to make changes. You don't have to continue to charge the old rate. This is just an example for you to understand. So when you receive information about taxes, you need to adjust it. It's very important. And then also if there is bankruptcy of a customer, and it is evident that the customer cannot pay their receivables, meaning that it's going to affect the total receivables figure, please, you need to do the adjustment when you are sure. Well, this is just an allowance for recoverable debt, a general allowance, but this is when you are sure that the customer has been bankrupt and cannot pay. You need to make an adjustment and write off the person's debt. That is what we are trying to say. So these are some examples of adjusting events. You can look out for more, but I just want you to understand the concept. And I'm going to also give you examples of non-adjusting events. Okay, so let's look at some examples of non-adjusting events. So examples of non-adjusting events. Now, what are examples of events after reporting period that you don't have to adjust on the financial statement? Now, the first example I will mention is about issues of shares and debentures. Issues of shares and debentures. In fact, when you issue shares after the reporting period, it relates not to the previous period. It relates to your current period that is ahead of you. So please, if you are issuing shares or debentures in January, February, you don't adjust it on the previous year's financial statement. Some of these things are clear to be understood. And then let's look at mergers and acquisitions. You are preparing accounts for 2022. In January or February 2023, you decide to do a merger with another business. Please do not adjust the merger on your previous year's financial statement. That will relate to the current year, not the prior year. So it's very, very important that mergers and acquisitions are non-adjusting events. And then if there is a reconstruction or a proposed capital reconstruction, so a reconstruction or a proposed reconstruction. Please, if you are planning to do a reconstruction of your business in the current year, do not adjust it on the previous year's account. It is a non-adjusting event. In fact, aside you being able to differentiate it practically, you could be asked these things in the exam to mention examples of adjusting events or mention some examples of non-adjusting events. And you should be able to do that. And then look at this. The purchase or sale of a non-current asset will be a non-adjusting event. If you are buying a non-current asset in January 2023, why adjust it on the previous year? It is not an adjusting event. In fact, you can list a lot of these non-adjusting events, okay? You should be very technical and be able to differentiate between events that affect the reporting period and events that will not affect the previous reporting period, given the time under consideration till the time that the accounts are issued for authorization. Let me finally add this. Changes in foreign exchange rates. Changes in foreign exchange rates are not adjusting events. If the exchange rate changes in January this year, you are not going to use the current rate to prepare accounts for the previous year. You still need to maintain the rate at the time of the accounts preparation or at the time of the period that the accounts relate to, not the current year. So if there are changes in foreign exchange rates, they are non-adjusting events. Now, what is the accounting treatment for adjusting and non-adjusting events? If you ask me, what is the accounting treatment? I'm going to make it very simple for you. One, adjust the adjusting events on the financial statement of the previous year. Two, don't adjust for the adjusting events. That is what I would say about the accounting treatment, and we have mentioned it already. So that is just how to understand examples of non-adjusting events and what to do with each of them. Okay, so before we look at some examples of some questions, okay, what I want to draw your attention to is that the last thing to talk about is to talk about the going concern issues after reporting period. Going concern issues and then also disclosures. Now, when it comes to the going concern issues, what I'll tell you is that when you are preparing accounts and management realize that there is likely liquidation of the company in the current year, or it's likely that the business has no evidence of going concern, then the accounts of the prior year should not be prepared on the basis of the going concern concept. If you have evidence that the business is not going to operate into a foreseeable future, and you have such evidence that it's likely that the business is going into liquidation or will have liquidity challenges, then the accounts of the prior year should not be prepared on the basis of the going concern. So as an event and after reporting period, once you have evidence of no continuity of the business, do not prepare the accounts on the basis of the going concern. That is what we are trying to say. Okay, so that is it. And then with the disclosures, now, even though we are not to adjust the non-adjusting event, but where the non-adjusting event, even though it is not to be adjusted on the accounts, but has an effect of affecting the decisions of stakeholders, then such non-adjusting events should be disclosed. So you disclose non-adjusting events that can affect decision of stakeholders going forward. So what we are trying to say is that if such, you see, maybe there is a merger or an acquisition, okay, that is going to take place in the current year. Even though in the prior year, we are not going to adjust that on the financial statement, but we are going to make a disclosure. And in making disclosure for such an event, you are supposed to make the disclosure such that it will reveal two things. One, please take note, the disclosure must reveal the nature of the event. So if it is a merger and acquisition, you state it. If it is a purchase of a key non-current asset that is going to aid production for future profitability, you state it. So you state the nature of the event. And the second one is an estimate of the financial effect. Okay, so you give us the financial effect that it will have, or an estimate of it. So what will be the financial implication or effect of such an event on current and future financial periods. So that is what you are going to disclose. So yes, it is a non-adjusting event, but you need to disclose the nature of the event. If that event is likely to affect decisions of stakeholders, you need to disclose, one, the nature of the event, and then two, the financial implications of such event. And that is what we are trying to say. And this will bring us to the end of part 1 of our lesson on event after reporting period. In fact, this is all there is to talk about. If there is a part 2 that is coming, then it's going to be about just solving questions or trying to illustrate some of the things. Remember to subscribe to this channel if it is your first time. Share this video, let others also have a benefit. And until we meet again for the next video, it's bye for now.